that would be to be a really high cap. When I think of high caps, it's a cap that most likely would be above your Series A valuation. So a cap that the notes have not been really priced. So that's sort of how I think about it. Question?
So on this conversation that you just had here with Ms. Eva, do you find that more sophisticated angels or investors tend to
Well,
more equity versus?
I think if you talk to most of the super angels, they are generally indifferent between the two. I've got plenty of deals, and we've got, many of the super angels have done notes as Series C. I'm not sure whether the last 3 deals are more of a trend. We're finding, investors more wanting the equity. But generally, there's been plenty of note deals done by all the major angel groups. So I'm not seeing people saying, I'm not going to invest in your company because it's a note offering.
Do you think a change in tax treatment for dividends affects that at all, or is it other dynamics?
No, I don't think investors invest in startups based upon dividends. Just, how that's going to be treated. They may invest because, and I think some of the smaller angels may like the 1202, which we'll talk about right now. So almost every company here will be a small business stock corporation. Basically, if you're an operating company, have less than $50 million of assets, you're going to be a 1202 company. And right now, if somebody buys equity, that stock qualifies for 1202. And the way 1202 works is if and when they sell that stock, if they've held it for 5 years, and it's an individual that's holding it or through an entity that's a pass-through, corporations are entitled to this. And there's all these other like restrictions, if the company can't do repurchases and so forth. But if the time you sell the stock, there's 100% exclusion from capital gains. So if I buy a notes, it doesn't qualify as 1202. So I don't get that treatment until the note converts into equity. But if I buy a stock and somehow in 5 years we get liquidity, I'll have 100% exclusion right now from capital gains. So that's more of a motivator than maybe. I mean, very few tech companies do dividends, very rare. But the 1202 treatment is a valuable asset that some people will look to do. Other negatives, so back to debt, I sort of skipped over this. There are companies out there, small startups, if you're in a field that you're working with some bigger companies, they may want to see your balance sheet. And so your balance sheet would have these convertible notes as debt. So it is debt on your balance sheet, and it can, on occasion, have to have a discussion with the customer of why you got this debt, and in fact, it's really equity. Security interest at risk of foreclosure. This is pretty rare with convertible notes, but it's there. How many people think if they're going to raise notes, are you going to go to maybe a strategic investor? Just a strategic's part of the plan? A lot of my clients think that they could maybe raise money from a first customer or a strategic partner or somebody in the business that would be complementary that can help get you going. Not uncommon. So when you raise notes or debt from a strategic, you have some different things to think about. And I've had this happen only once in my career, but it did happen, where we had a startup raise some money. Not that much money, but a sizable amount of money from a strategic. The startup couldn't get its Series A done. The notes matured. The investor insisted on a security interest, which is not market, but they insisted on it, and they actually did foreclose at maturity and took the company. Now, most investors have no desire to run your business. It's just not part of they're too busy to run your business. But that's one, potential negative with a note would be if you give a security interest and it does mature, somebody could technically foreclose. and find the risk really only higher with strategics, with the security interest. Again, negative covenants, we don't see those generally for a traditional convertible note offering. So a negative covenant would be a restriction on, it could be a restriction on new debt, a restriction on selling the company, it could be a restriction on changing your business model. Those would be typical restrictions we could see. If you look at our forms and most other forms in the Valley, those forms won't have those negative covenants. And usually what happens is you could have a sophisticated investor that comes in that wants those negative covenants, and then you would have to either amend the documents or have a side letter granting these negative covenants. But you do see those. Sure. The way the convertible notes work is whatever the price of the next round is, it will convert into that round with most likely a discount. So if you do an equity round, you price the round, and generally with equity, the anti-dilution is something we call broad-weighted anti-dilution. That's the terminology. So the difference between ratchet and broad-weighted is fairly simple. So if we'll talk about a note deal. Say we have a note deal and we do a cap of just $5 million. Okay, you have a $5 million cap note, and you think you are going to give away 10%. You're raising about $500,000 of notes, and so the notes when they convert should be 10%. If you do your Series A round and things have just gone poorly, and the only money you can get is at, say, a $2.5 million pre. Okay. The notes will convert, not at that $5 million cap, it will convert at that $2.5 million number. So it's a dollar for dollar ratchet anti-dilution. Whatever that price is, they will get that price with a discount below it. So there'll be, if you have a 10% discount, a 10% discount off that price. So in an example where I said that notes were going to be 10% of the company on conversion, now it's going to be, in my example, 20% because it's half the price. Okay, so that's how the ratchet is basically whatever the Series A. With respect to if I had done this as an equity round, so if I did that same deal, if I sold that investor 10% of my company for $500,000 at that $5 million pre. So he now owns those, or she owns, or the investor now owns those shares. If and when I did the next round, and it was priced at half the price, down to the $2.5 million pre, the broad-weighted anti-dilution would not be a dollar for dollar reduction in price. There's a formula basically where you look at how much money you're raising at that valuation, and you look at how many shares you have outstanding prior, and you sort of weight it. So if you do a little round, say I do a little Series B round at $2.5 million, like just a couple $100,000, the adjustment to the prior round is pretty small. But if it was with convertible notes, everything would go down. So it's much more of a dramatic change. And what's interesting is when you do equity, the market is this broad-weighted average anti-dilution. We rarely ever see ratchet anti-dilution ever in equity. I can't remember a ratchet anti-dilution deal that I've done. Have you ever, Amanda? No. It's just not market for whatever reason. But for notes, that's what it is. Thanks.
Sorry, so just a quick question. So with respect, could you give an example of what typical amount of money someone would get, or what would be the valuation of that note in the same case where they got, they bought 10% of the business for 500K, they end up with a valuation of $2.5 million for their next round. What would be the percentage of the company the equity holder would have? Would they basically still be stuck with 10% and basically see the value of their investment half?
So the formula for broad-weighted anti-dilution depends upon how big the other round is. So if it was, say, the same size of round,
Right.
you know, it would be a much smaller dilution. So put me in my math, but I would imagine, Amanda, it'd be about 20% dilution, about 20% versus the full 50% more.
Okay.
You know,
So then up about 12.5% then, is that what you're saying?
yeah.
Okay.
I'll take a step back. One thing about resources. So we at Orrick have on our website, if you go to orrick.com, our merchant company website, we actually have all our forms, you know, online for free. We have our term sheet for free. We actually have a term sheet creator where you can go in and plug around different things. And it's a very valuable tool. We actually have all our formation forms, corporate forms, NDA forms, the ones that we use internally are online for free. And so we'd rather have people use our forms that are market tested that work than not use them and use something that doesn't work. I raise that is because if you want to look at the formula for broad-weighted anti-dilution, it's in our form, it's in the charter. And if you want to email me, I'll send you the formula. But it's one that if you're the main thing is if you are an entrepreneur, you don't like ratchet, you like broad-weighted average, and that is the one small difference between a note deal that you have in a ratchet. Okay, common terms for convertible notes. So generally, when we do a convertible note offering, again, the whole idea is the convertible note will convert into a later equity round. So the later equity round will cause the conversion notes into equity. And generally what we want to do is have an offering of notes. So we don't sell one-off notes. I don't like clients going off and selling an individual note to Nick, an individual note to Mike, and an individual note to Christian. We want to have a note offering. We'll have the same note purchase agreement that'll cover everybody, because every time you sell a note, you're offering securities, and there is securities law compliance. And it's easier for the lawyers to handle the securities laws if you just do one offering. We have one filing, much more simple, and you're off and you're running. And we can, as I mentioned up front, tranche the notes, so you can sell, I could sell Nick one price and Christian a higher price. I gotta tell them, you can't not tell them they have different prices. I get that question sometimes. You know, so you want to have the question back there.
Just when you say selling at one price versus another, if it's on a convertible, then you're probably talking that price is really in a discount form?
Yeah, so what I meant by different price is the cap and the discount.
Gotcha.
Those are the main two terms. Those are your main variables, the cap and discount, which we'll get to. So generally what I recommend to clients is in your note offering, you know, do more than you think. You don't have to sell it all, but I generally don't want you to have to amend your documents. So if, I'm picking on Nick because he's up front, if Nick thinks he needs a couple $100,000 to get his business to the next level, I would encourage him to authorize $500,000 of notes. You don't have to sell them all, but you have the documentation there, and then you can keep selling them up to that point. And because if you run out of the first 250, you don't want to have to pay Amanda more money to either amend the documents or do another thing. Go ahead.
Okay, so you're talking about multiple closings and different prices for the convertible notes. So does your anti-dilution kick in, or is this considered the same round?
Yeah, no, that doesn't. We're talking about the notes. The anti-dilution would kick in when you convert them to the equity.
When you convert them, so even if you price, say those two NATOs at different prices,
Different caps.
Different caps, yes.
Yeah.
The anti-dilution doesn't affect anything.
No. The only time the anti-dilution would kick in is when you convert those notes below the lowest cap.
Right.
So then that person would get the lower price. And if you had a higher cap at the next one and you priced your round below that next cap, then you know, we're talking about this. I guess we'll just talk about it now. I find it difficult to do various valuations at early stages unless you have a milestone. You know, there are different people sometimes say, listen, for the first money in, I'm going to give you, say, a 20% discount and a lower cap. And then the next money, anything comes after the first month, will have a different number. But if I've got a good investor here and he sees it, he's just a couple days or a week later than the first money, he's going to like say, well, I want that same deal. And so generally, my advice is, you know, try to keep things simple. Don't overcomplicate it. If you reach a milestone, maybe you can change the terms, but it's very difficult to basically have two investors at the same time have different prices. It's not rational to me, and most investors would not accept it unless somehow unless something happened between the two. My advice would be keep it simple, keep the terms straight, and if you hit a milestone, then you can stop the offering, and we can think about it. We've already talked about rolling closes, cap versus discount. So these are the two equity kickers. So the whole idea of an early stage investor is it's not a loan, right? This is not a loan. They want equity kickers. So does everybody understand the cap? I think we've covered it pretty well. Do I need to cover it again? Okay. So the cap deals with the valuation. Let's talk about discounts. A discount is a discount in connection with that Series A round. So if you did a Series A